All right, good afternoon, everyone. Welcome to GoalsGetter, Lunch with GoalsGetter. This is season two, episode two, as we're calling it. Now, it's been a hive of activity here in the Nikko office at the moment. We've got 19 business days left until Nikko rebrands to Amova Asset Management on the 1st of September. So you should have all received yesterday an email with the Amova brand pack, which includes our new logo and brand guidelines in case you need to update any of your documentation or websites. GoalsGetter, the GoalsGetter platform is still going to be called GoalsGetter, so that's not rebranding, but there will be some changes to the color scheme that will roll out on the 1st of September as well. One of the most exciting things about these changes from a GoalsGetter and KiwiSaver perspective is that the advisor and the advisor client onboarding process is being streamlined. So you'll now have an even clearer and more intuitive dashboard to track applications and see the projection tool for clients. Clients will also be able to accept your KiwiSaver application in one click now as well, making it much more streamlined from their end. Now, in the interest of time, I'm going to hand over to our speakers for today. And first up, we have Nathan Field, Portfolio Manager of the Generate Thematic Fund. Nathan runs the Generate Thematic strategy. He's got over 25 years experience in the financial industry, including analytical roles for investment banks in the UK and Australia. Prior to joining Generate, Nathan ran a global thematic strategy at Kiwi Wealth, where he built a 10-year track record of outperformance during the period of 2013 to 2023. The global equities funds under his management beat the market index by more than 4%. He holds an honours degree in economics from Massey University. So I'm going to hand over to Nathan now. He's going to speak for about 25 to 30 minutes and wrap up just around 12:30 before we hand over to our next speaker of today. So that's over to you, Nathan. I'll pull up your slides now for you. We'll get that underway. Is that showing okay for you there, Nathan?
I can't see anything, but
You can't see anything. Okay, that's a good start.
maybe that's because I'm a.
Let's have a look. Cool. How about that?
Here we go. Yep.
Perfect. All right, over to you, Nathan.
All right. Thank you very much for the opportunity to speak about thematic investment and generate thematic funds in particular. Thematic investing is something I'm very passionate about. I've been doing it for a while, and I think it's a style that really works, and there's real demand for it in New Zealand. So let's kick off, shall we, with the first slide. What is thematic investing? Well, in a nutshell, it's an investment style that focuses on the underlying trends and the big themes that are impacting corporate earnings around the world. So the theme always comes first, then stock selection. And that's really the key difference between thematic investing and traditional bottom-up investing. It transcends traditional market characterizations. It's not value or growth. It's not large cap or small cap. Once you have a theme, you're free to really invest across sectors and countries and market cap sizes, just depending on where you see the alpha opportunity. So thematic investing doesn't have any style constraints. Thirdly, as a general comment, the themes tend to be secular and operate outside and independently of the economic cycle. That's not strictly true for our fund, where we have some economics expertise in the team. So we do like some macroeconomic themes from time to time and actively invest in them. But as an investment style, themes do tend to be secular and macroeconomic trends are not really part of the picture. And finally, there are lots of different ways to invest thematically. You can invest in ETFs, which focus on particular themes like, cloud computing or green energy. They can get very targeted and specific. You can invest in a space travel ETF or a cannabis ETF if you want to. And then away from the ETFs, you get the diversified managed funds, where you have a wide range of themes that are actively managed. And that's the kind of fund we operate at Generate. So, next slide, please. So let's take a look at some of the investment themes you might see in a thematic portfolio, and I've divided them into three broad buckets, but this isn't, this isn't written in stone. It's just the way I like to think about things. First, you have socio-demographic trends, and these relate to things like changes in population and household structure, shifts in consumer tastes and behaviours, and also social and cultural trends. I'm sure you recognise most of these themes listed here: ageing population, pet humanisation, that refers to all the money that young people especially are spending on their fur babies, and office casualisation, and that refers to the fact that you don't have to wear a suit and tie and high heels to the office, or at least not in my office anymore. And that's been very positive for casual wear and leisure wear. The second broad bucket there is technology, and that's typically what most people think of when they think about a thematic fund. It's these big mega trends like artificial intelligence, cyber security, and robotics. Thematic investing is very future focused, and a lot of the themes are technological based, and certainly Generate's thematic fund is no different. And thirdly, as I mentioned earlier, macroeconomic trends. I guess that's not typical of thematic funds, but for us, we do invest in economic trends, such as thawing capital markets. We've had 3 years of very high interest rates and low market activity. We see signs that interest rates might be hitting a peak, and things like the housing market, the IPO market might be warming up. So we have exposures there. A China recovery, whenever that happens, that's going to be a mega trend, and things like infrastructure spending, because infrastructure is crumbling in a lot of the developed markets in the world. And when governments get their act together, there'll be some money to be made there too. So next slide, please. So now we know some of the themes in theory. I'll just go through our thematic investment process that we have at Generate. This is a simplified version of it, obviously. And the first step in the process is undoubtedly the most important, and that's to identify a theme or a trend that we want to invest in. And we're agnostic as to where a theme or a trend might come from. It can be something we've read in an earnings report, or a management or heard on a management call, something we've picked up at an industry conference, read on a technology blog, even just keeping our eyes open when we're walking around the streets and noticing what people are wearing or how they're using their phone. We don't discriminate as to where an idea might come from, but the one caveat is that there has to be a path to monetization. It can't just be a trend that you've noticed. There have to be profits that we can see in companies that can leverage that trend or theme. So the second step is, once we've got the theme that we want to invest in, we identify some key large cap stocks that give us exposure to that theme. And we do not exclusively invest in large cap stocks, but that's certainly our first port of call, because we're trying to reduce idiosyncratic company risk in the portfolio. So we tend to focus on household names. If we want to invest in online payments, we're going to invest in Visa and MasterCard and Amex. We're not looking for that second tier of card companies. Once we've got those stocks or our shortlist, we'll run a quality ESG and valuation check on them to make sure they meet our internal standards. And the stocks that get through that, we'll consider in a total portfolio context, and make sure that we're retaining appropriate levels of diversification and risk management. So next slide. So that's the process, and I thought I'd just focus on an example of a theme, and I've picked the most obvious one out there because it's on everyone's mind: artificial intelligence. I think it's a theme that's in every thematic portfolio in the world, but for good reason, because it really does affect a lot of other themes as well. It's at the center of a lot of mega trends that are going on in the economy at the moment, from workplace productivity to autonomous taxis to data centers. AI is really at the center of a lot of the biggest technology themes at the moment. And you might have heard some people talking about AI as a bubble, but most of those people are from the financial industry, because the technological guys, the technology industry is all in. Microsoft, Apple, Alphabet, they're all investing heavily in AI, and they believe that this trend is the biggest thing to hit technology since the advent of the cloud. So, I'd be taking the side of Microsoft and Apple more than some data crunchers in Wall Street any day. Next slide, please. Yeah, and in the world of AI, NVIDIA is still the undisputed king. They make the GPUs that are needed to train AI models. They're building out their product range to include software and infrastructure to maintain and extend its lead. There's good reason why it's the most valuable company in the world right now. Just overtook Microsoft once again. You can't really invest in AI and not have a significant position in NVIDIA. It's not as big as an overweight position for us as it used to be, but it's still very much core. And the name NVIDIA is synonymous with AI, and we think that's going to continue for the foreseeable future. Next slide, please. But as important as NVIDIA is, the theme is broadening out and pulling in a whole ecosystem of other companies that stand to benefit from the trend, from companies that supply equipment to AI chip makers, to cloud service providers that will handle all the extra AI traffic, like AWS from Amazon and Azure from Microsoft. We own a selection of these companies that you see on screen. Some of them household names, others not as well known. But the main point is the theme is broadening out, and we think the list of winners is going to continue to grow. Next slide, please. So outside of AI, this slide just highlights some of the other themes that we like at the moment. Electrification, which is, I guess, a second derivative play on AI, because all those new data centers that are packed with AI chips are extremely power hungry, and to cope with that extra demand, there's going to have to be a rapid and substantial expansion of the power grid, particularly in the US. So we've got a range of exposures to that theme. The companies there are Eaton, which manufactures a broad range of power equipment, Amphenol, which specializes in electrical connectors, and Wesco, which is a leading distributor of electrical products. So electrification is, it's a little bit like AI. It's a long-term theme, which we think is going to play out over decades rather than years. Another theme we like at the moment is maturing category killers, which really refers to businesses that have spent the first decade or so of their existence building up their dominant position in their respective markets, producing services that people have grown to rely on and love, and really growing their revenue. But now that they have the scale, they're using price to drive profits. And the operating leverage in their business models is really coming through. So they're moving from becoming great products and services to great businesses to invest in. And yeah, I'm sure you've all heard of those stocks on screen there: Netflix, Spotify, which just overnight increased its subscription price, and Uber. And thirdly, just to show that we don't always have headline grabbing hyper growth themes in the portfolio, waste management is a long term theme that I've liked, and that's in the portfolio, particularly in the US, where the industry is really consolidating around the three major players: Waste Connections, for public services, and Waste Management. It's a great industry because demand is constant. People are always making more trash, and you've got consolidating supply, very high cash flow business, an important job that has to get done. So yeah, we like to balance out some of the hyper growth themes in the portfolio with some steadier businesses and some more defensive themes. Next slide, please. And so what we get when we put all these themes together is a diversified portfolio of very high quality, mostly large cap stocks in different countries and different sectors around the world. And yeah, risk management's a focus for us. We don't operate the portfolio like, say, a Kathy Wood's ARK Invest, which is, sometimes high return, other times bigger losses, but definitely on the riskier side of the spectrum. We control risk by keeping our tracking error and tracking error in check, and keeping a broad range of stocks in the portfolio. I think we've got 63 stocks at the moment across 11 different themes. So risk is well managed in the portfolio. And I think global thematic or the Generate thematic fund is very appealing to local investors, perhaps even younger investors who want to get exposure to some of these big trends and themes that they've seen in the news. And this is a risk-controlled way of doing that. So I think I've finished early, but hopefully that means there's more time for questions if you guys have any.
Great, thank you, Nathan. So yeah, just a reminder to all attendees, if you do have a question that you'd like to ask, please use the chat feature below to put your question in there. Just to get us started, Nathan. So for the sort of one of the themes of today's webinar is around high growth and aggressive investment options for clients, and so thematic fund fits into that category. For advisors using GoalsGetter, there's also the Generate Focused Growth option as well on the platform. Can you talk around how the thematic fund fits into the focused growth fund at all? Is it a reasonable sized portion of that fund?
Yeah, so currently the thematic fund is around 25% of the equity exposure of focused growth. So the other parts of focused growth are another global portfolio run by my colleague Warwick, who's based in Seattle. He's slightly more concentrated, slightly more value focused. And we also have an external managers fund run by Sam Goldwater, which is also mostly international exposure. And then there's an Aussie New Zealand component as well, which is about close to 30% of the portfolio. So yeah, you get a very diversified portfolio and focused growth. I'd argue thematic gives you a reasonably diversified portfolio, but yeah, it's 100% global stocks, and it's very focused on those 11 themes.
Great, thank you. Now we've had a question come through in relation to specifically the thematic fund. So what is the US exposure in total? There seems to be a large number of US stocks, and do you control asset allocation risk at all?
Yeah, we have a broad internal restriction on country exposure, which is no more than 15% above the MSCI World benchmark weights. We're well below those. I mean, the MSCI World, the US makes up around 74% of the MSCI World at the moment. Our fund has about 80% exposure to the US. So we're running, yeah, about a 7 or 8% above benchmark position in the US. And look, our US positions are so broad. I mean, they're multinationals. If you look at the revenue um, breakdown of those companies, it would look far less US skewed. We just invest in the best companies, and it just happens that a lot of them are based um, in the US and in Silicon Valley in particular, because they really do. US firms really do dominate that technology space at the moment. But we tweak our country positions depending on where the trends are pointing and depending where prices have gone, because obviously things get even the best companies can get expensive at times. But yeah, we keep our country risk within check.
Great, thank you. And another question has come through. So what are the emerging market themes that you're seeing at the moment, apart from the China recovery?
We don't specialize in emerging markets. They're not part of our benchmark. China is something we can't ignore because it's such a big part of the global economy. But if we do want to invest in China, we're most likely to go for multinational companies that sell into China rather than companies that are based in China, just because there's governance issues there. Even accessing the stock market in China is fraught with difficulty. I would rather buy an LVMH or a Nike or a Lululemon that will benefit from a Chinese economic recovery without actually going into the Chinese market.
Great, thank you, Nathan. Great answers. That's everything that's come through from advisors at this point. But advisors, if you can keep putting questions throughout the duration of the webinar, we'll try and get around to those at the end. But for now, unless there's anything else you want to add, Nathan, I will pass over to Alan Clarke in a minute.
Great, thank you.
Great. Very good. Okay, so next up we have Alan Clarke, Portfolio Manager of the Nikko Diversified Funds and External Managers. So Alan joins Nikko in 2023, and he's responsible for providing overall management of the diversified funds and for managing external investment managers. He has over 20 years experience in investment management, both as an analyst and portfolio manager. And prior to starting at Nikko Asset Management, Alan spent 16 years at ANZ Investments. He's also held roles at Theta Capital Management in Amsterdam and Morley Asset Management in London. Alan holds a Masters of Science in Technology degree from the University of Waikato and has been a CFA charter holder since 2009. So I'm going to pass over to Alan Clarke now to talk about the new Nikko AM High Growth Fund, which is available on GoalsGetter. So over to you, Alan.
Thank you, George, and good afternoon, everyone. Thanks for your time today. Excited to talk about what is our newest fund, the Nikko High Growth Fund. And this was just launched last month. And just to start things off with sort of the why for launching this fund, we have had a lot of advisors and clients asking us, particularly for those younger, and particularly KiwiSaver members who probably, a lot of their working life ahead of them, could we, not build a fund that will sort of went beyond what a typical growth fund would and have effectively even less of those defensive asset classes, cash and bonds in them, and that's where we've come up with the high growth fund, and like our, just trying to make sure. Like our other diversified funds, the conservative, the balanced, the growth fund, we have sort of taken a building blocks approach here. So just showing the sort of what we think of as the different building blocks or the different asset classes, the different funds that we use. This is just what you would see for our other ones, except of course the other ones would have more of those, more cash and a larger allocation to those fixed income markets, both locally and around the world. And one point of difference for us versus some of our competitors, we're a bit more of a combination of some asset classes done internally. That's the Australasian market, effectively, whether it's equities or listed property or cash and bonds. So that's around about a third of this fund. And then for the global asset classes, we've taken an external manager approach for a number of years. And I thought what would be interesting today was to dig a little bit more into that global equity approach we have, where that 67% of the high growth fund is managed by 4 external managers that we've selected and combined together for that global equity allocation. Before I do get there, I know some of you are familiar with the local team here, but for that other third of the portfolio, the Australasian asset classes, those are managed by our equity team in-house here. So the core equity fund and the concentrated equity fund, that's Michael Sherrick and his team, and also the property fund that invests across Australasia, and the cash fund managed by our internal fixed income team led by Ferg McDonald. So I'm just going to take it as a given that some of the audience are familiar with those folk. You might have seen them presenting at some of our conferences in March or in September. And like I said, today I'll try and focus on the global asset approach we've taken. One other point, maybe before I get there, there are some great companies to invest in around Australasia, and that's what the local team or the in-house team here is aiming to do. But of course, as you know, a large part of the New Zealand equity market in particular is what we call defensive, and that's not a sort of bad thing. It means that a lot of companies are a lot more sort of in stable industries, often a high, nice, stable earnings yield, dividend yield. That's a good thing to have in any diversified fund as we think about getting a blend of different sort of types of investments. But of course, what we don't see in that Australasian market is exposure to some of these exciting sort of growthier opportunities, new products, new services, new technologies that are being developed around the world. So when we think about our allocation to global equities, we are thinking of this as the sort of the earnings growth and therefore the share price growth sort of driver is going to come from those. It is more likely to come from that really large universe of global stocks. If we think about the exercise there and across sort of maybe the first or maybe the most developed 40 odd countries around the world, sort of the number of listed companies on a credible stock exchange in a country with a pretty good level of law, and assuming you're not going to go into the very, very, very small companies, you can easily start with a universe of 5 to 10,000 companies. And what we're sort of looking for our external managers to do is to sort of within that reasonably large universe across the whole world and across all those different sectors and regions and industries, is to sort of get our clients exposure to some of those exciting companies, in particular those companies that have got a pretty exciting growth profile ahead of them. When we think about partnering up with external managers, we genuinely think about it as a partnership. So in terms of what we're looking for, effectively before we would appoint a manager, we've got our assessment criteria down there. I'd suggest that's not too differentiated to many others. We want to understand on the left there. We want to understand the business, the stability of their business, the success of their business, how long they've been around, the people. We're thinking about the investment team, but also the key people that are involved with running the business. Have they been doing it for a while? The philosophy and process is important. We're spoilt for choice. If there are sort of 5 to 10,000 credible or listed companies around the world, there are many, hundreds of different approaches to global equities. So we're not sort of short of choice. And what we can do there is we can sort of think about whose philosophy, whose investment process resonates with what we do here in Australasia. So if we think about, we have a preference for sort of quality investments. We're sort of long-term, some of those highlights above their long-term approach to investing. We're not, locally, we don't sort of think of ourselves as short-term traders. So guess what? We don't sort of look to appoint some of those more sort of esoteric high turnover strategies that are available out there. The responsible investing piece, of course, is more and more important every year. That's how, to what extent has an investment process integrated these really important considerations in the areas of environmental, social, and governance risks and opportunities. And then, of course, the performance is important, but as we all know that, it's very easy to find managers who have been successful. We need to get comfort that there is, something about this firm or something about this team that gives us confidence that that performance is enduring going forward. And then moving to some of the other highlights, we work with what we consider to be institutional caliber managers. What do we mean by that? Well, many of our clients are what we call institutional investors. They're often supported in their appointment of a manager by a research consultant, an investment consultant. It might be a Mercer or a MJW. So, when we're sort of presenting the managers that are behind our funds, we expect some of our clients to have heard from their investment consultant, what do you think of this manager? Are they credible? Are they experienced? And we've got a sort of a pretty high, what we think is a pretty high bar for appointing a team. And again, that experience, we're looking for teams that have been around for a number of years through multiple market cycles, and that sort of collective knowledge of handling no matter what the world throws at them. So what does our global equity fund look like? It's a combination of 4 different managers, shown here in a rather busy slide. If we think about the top 2 first, they're the Royal London and JP Morgan, so slightly larger allocation to those 2 managers. They are what we would describe as sort of core style neutral managers. We'll get onto that in a bit, but if you think about that universe of sort of opportunities, companies at different stages of the life cycle, we're sort of tasked them with building a sort of reasonably balanced allocation with some exposure to growthier names, but also a bit of exposure to the unloved or forgotten about sort of value names and everything in between. Still reasonably concentrated portfolios there on the right. There's no perfect number, but because we've got 4 managers, we effectively we're wanting their sort of high conviction best ideas funds. We're unlikely to sort of work with a manager that, because we've got 4 of them, we find it less attractive to have a manager with 150, 250 stocks who have effectively diversified away a lot of their risks. So high conviction best ideas strategies is what resonates with us. The bottom 2 managers are what we think of as our growth managers. So Nikko Asset Management in Europe and WCM in California. Those are if we think about global equities, there's been a slightly more exciting opportunity set because of all those amazing sort of products and technologies and services. The growth managers get to sort of fish in that exciting part of the pond. They're looking for companies that are typically would be normally expensive because of this identified growth opportunity. But if a growth manager can identify those names that aren't priced for perfection or aren't priced for ridiculous levels of growth, that is a sort of really sensible way to invest, to get exposure to those new ideas that have been developed by companies around the world. And just like with, there's no perfect size of the team. We've got a mixture here. You think about a JP Morgan, they'd be what you'd describe as a sort of one of the largest fund managers in the world, probably top 20 by AUM. So that's a large team spread across 9 different cities around the world, investment analysts and portfolio managers. The other 3 would be more of effectively a boutique sort of, in particular Royal London and Nikko. That's more of a sort of boutique team within a larger organisation. And then WCM a little bit somewhere in the middle. That team of 26 is specifically the WCM strategy. Across that whole firm, there's 40 plus investment analysts and PMs doing other slightly different strategies. So there's no perfect number of or perfect size of a team, but again, as long as it's sort of well resourced, the team's been doing it for a number of years, they understand their brief, and importantly for us, they fit in with the other managers. Then we have a range of different sizes there. But what gives our clients a lot of comfort is that this global equity fund, the success of it is driven sort of not by 1 or 2 people. We've got exposure to 120 plus investors and PMs and analysts spread all around the world, looking through that really large opportunity set. I thought for today, what would be interesting would be to sort of dig into one of these managers in particular. So I will spend a bit of time on WCM. Some of you will have seen, again, if you'd come to our March or September sort of lunches or conferences, summits, you might have seen the Nikko Europe team. But I thought today would be interesting to sort of dig into the WCM in particular, who I think are one of the more fascinating managers I've come across. And moving back to the high growth fund for a bit, what does this mean? Well, we saw before that around 2/3 of the high growth fund is going to be invested in that global equity asset class. It is sort of looking for that growth opportunity in all those exciting areas around the world. But what we have is, and when we go back to our high growth fund, is that we've got the sort of our expectations as an active manager, our expectations for how we're going to sort of outperform our benchmarks over a full market cycle over the long term. It is spread across, not one investment team, effectively 5 different investment teams. I've talked, so on the right there, 18% and 4%. Think about that as our colleagues sitting here in Auckland, the Australasian equity team and listed property team. And then you've got Nikko Europe and WCM, Royal London, JP Morgan Asset Management. Over time, we're expecting the added value to come from across a reasonably even slice of those 5 different approaches. And again, we think that gives us not just getting diversification by region, by sector, by industry. That's not that difficult these days to build a global portfolio or a sort of global high growth portfolio. But having exposure to a range of different investment teams as we think is sensible for over any market cycle. We know that some of these teams may have some difficulties, may have a year or two of underperformance, but over the long run, we think they'll all do well, and that they'll all help the overall fund outperform, and effectively the combination of the different approaches builds a sort of portfolio that's greater than the sum of its parts. The track record here of this fund is, like I said, this fund has been around since about 2008. You'll be well aware, of course, that past performance doesn't guarantee anything, but I just wanted to spend a little bit of time on this slide to sort of dig into within global equities. One of the reasons we have 4 very busy slides. So just to give a little bit of color here, what we're showing is the annual or the calendar year performance of the 4 different managers. Now, a couple of things to point out. JP Morgan has only been added to this lineup, if you like, last year. And Nikko Europe added about 5 years ago. But what we want to show here is that there are, and particularly in this last 5 years when we had that very unusual environment, or that the crazy COVID experience with first the lockdowns, then the reopenings, the inflation, not scare, the inflation spike, the central banks rising interest rates, bonds sold off, equities sold off, the equity market sell-offs and rallies in between. So we had an incredibly volatile time. So no kidding, some of these managers had very strong years and some of them had some tough times. But what we're looking for is a combination of managers that will not have their sort of difficult time at the same time. That means we wouldn't have too many years like 2020 where they all did well. The aim is that sort of no matter what that sort of macro landscape throws at us or throws at these managers, that there will be one, 2, or 3 of the managers will be doing the heavy lifting, and we can sort of we can accommodate periods where a manager that we think is a very impressive approach that we've got confidence in, but when they endure those short-term periods where their style is out of favor or they've maybe made a few stock selection mistakes, we can sort of endure that. We can have those long-term partnerships we're looking for, as long as they sort of stick to their knitting, continue following their investment approach. So when we think about 2022 and 23 in particular, those 2 growth managers, WCM and Nikko Europe, having had a really good run through most of the 2010s, sort of almost one final ramp up in 2020, very strong outperformance. Then not that surprising, at some point that style comes off the boil a bit. So 2022, 2023 was a difficult time. But again, while WCM and Nikko are both growth managers, we think they're different enough and that they won't sort of endure the same success and failures at the same time. And that's what we saw there. WCM had a really tough year in 2022. 2023 was the tough year for Nikko Europe, but again, in aggregate, the portfolio, the multi-manager approach has continued to deliver, and that's what we know. If we'd taken this exercise back to pre-COVID to the late 2010s, it would have been the 2 style neutral managers. It would have been the 2 growth managers doing most of the heavy lifting, and the 2 style neutral managers were having a slightly tougher time. And what does that all sort of add up to? It adds up to a sort of track record that, we're looking for sort of 2 to 3% above the benchmark over a full market cycle. And this combination of managers, or the strategy at the top there, the multi-manager approach has delivered that. just wanted to spend a little bit of time before I dig into WCM, which again, thinking about the global equities as the exciting part of a high growth fund, or the growth managers are the exciting part of the global equity opportunity set. So just a little bit of time on investment style. There are many different ways you can slice and dice a global equity universe. We can think about it, and we do sort of look at it by market cap, does an approach or a strategy or a portfolio have exposure to mega cap, large cap, mid cap, small cap. We can of course slice it by region. We can slice it by financial sectors. Do we want financials, consumers, etc. One simple way to think about it is to sort of think about companies in terms of growth versus value. Now, it's often written or talked about as if it's a sort of binary thing, or a company stays there in one box for forever, if you like. It's never, it's never quite that simple. But we really like this sort of chart, which was from Royal London. It's a couple of years old now, but I think it does a really good job of showing. It shows their approach to investing, which is to think about companies as to in the sort of lens of where are they in their corporate life cycle, where are they, and as they're evolving as a company, where are they? Now, why does Royal London do that? It helps them compare like with like. So no kidding, if you're looking at NVIDIA, a successful company many of us might not have heard of 3, 5, 10 years ago, versus a Canon, maybe a bit more of a turnaround story. Company that's been around for a long time, well known, but guess what? Well-known companies have difficult times. So that's going to be more of the, that's more of a turnaround stock. But to compare the two of them, do I want this one or that one or both? It is an easier exercise if you first effectively put companies in these 5 different buckets of where they are in their life cycle. So think about the y-axis there, the left-hand axis would be, it could be return on invested capital, sort of some measure of how much, is this company growing their earnings, delivering in terms of a rapid return on invested capital? And no kidding, those exciting companies that have come up with a sort of amazing new product or technology that suddenly the whole world needs, those companies are growing that ROIC, return on invested capital. They're growing their earnings very rapidly. At some point, the laws of sort of capitalism and competition have usually moved them into that more, still an exciting phase, still growing your company quickly, that compounding phase. But again, usually at some point, the classic life cycle would have you then move to slowing and maturing. And so we like this. We think it's a really sensible approach that sort of sits behind that Royal London approach to building a core portfolio. But we do think it's also a good way to frame up sort of growth versus value. And what we're tasking our core managers with, the managers that have sort of 60% of the portfolio, 60% of the global equity portfolio to manage, we're sort of tasking them with fishing in those 2 left-hand buckets, those accelerating companies, compounding, maybe some in the slowing and maturing. And it's the core and also an allocation to those slowing and maturing companies, and an allocation to some of the turnaround stocks, and an allocation to those mature stocks. WCM and Nikko Europe, sort of by contrast, are mostly going to be fishing in those left-hand 2 buckets. So the growth managers on the left there, predominantly looking for sort of companies like NVIDIA, like Google. What will be the next sort of NVIDIA? What will be the next Google? The next Amazon? But also, and that's that more exciting part of the universe. The bottom numbers there, again, a couple of years old. That was Royal London's estimate for how the global equity universe, the MSCI World Benchmark, is spread. So it's not a perfect 20% of the global equity universe across these 5 buckets, but it's not too far off. And that will change over time, of course. The global macro cycle does impact this. If we did have a sort of large global recession, you would see more companies move to the right there, have some difficulties. Their businesses might mature faster than normal. They might move into the turnaround bucket quickly. And there are times when a super strong economy would allow companies to maybe stay in the compounding bucket for longer than would otherwise be the case. But over time, it's not the worst sort of way to frame it up, is that with capitalism and creative destruction and new technology has been invented and brought to market, that this is sort of always happening everywhere, regardless of that. And while the global macro cycle might change the speed at which companies move, or this this stuff will still be sort of happening. And then so with across the four managers with our global or four manager approach, we end up with we show the top 20 holdings here. So not surprisingly, there is some commonality. There are some names, particularly in that not all of the sort of the famous or infamous Magnificent Seven, but Microsoft, Amazon, Nvidia, as of 31 March, were the only companies that all four managers held. And then it is often some of the other sort of large or mega cap companies. Think about Taiwan Semiconductors or United Health Group that all four managers or three of the four managers have held. But then once we get further down the sort of portfolio size, it is some of the smaller companies that maybe not common household names. Then we get that sort of that those companies are sort of brought to the overall portfolio by often one manager, sometimes two managers. And I think with looking at any sort of global equity portfolio, you might recognize a number of these names, but there should, especially in that growth part of the sort of portfolio, there should be some names that aren't household names yet. Like I said, Nvidia wasn't sort of as well known as it is now, sort of 3-5 years ago, and the task of a growth manager is to identify those winners a lot earlier in the piece, and that's, like I said, the exciting part of the portfolio, where we're looking for that rapid earnings growth and which can lead to that rapid share price growth as well, if they are the sort of the winners are taking more, the winners in that sort of accelerating part of the life cycle. Thought I'd just, like I said before, to drill into one manager in particular. Why WCM? Well, partly because I think it is the most exciting part of the portfolio with the types of names they're invested in. If anyone here on the call has heard Nikko, the Nikko Europe team led by Will Lowe and Ian Fulton talk, they are what we'd describe as a sort of classic growth investor. They're looking for those companies in those sort of left-hand two buckets, if you like, looking at future quality. How will a company sort of win and keep winning? Well, WCM is overall will build a portfolio, slightly growthier again. Not looking to invest in unprofitable companies that may become the next Nvidia. That's a different investment style that we'd sort of consider as a little bit too risky and low quality, but still investing in a lot more companies and if you looked at this top 20 holdings from their portfolio, you recognize a lot of those names, but there's probably a few names that you may not have heard of. So they are getting exposure to growth in ICC there and Indian Bank. And sort of some of the big drivers lately in Europe, for example, with the commitment there from the European countries to spend more on defence, more on energy production, and more on infrastructure. That's played out there with Siemens Energy and BA and Rolls-Royce. So that's the sort of, they're looking around the world for where is there opportunities for companies to grow quickly. And this is the sort of exciting part of the portfolio. The metrics there on the right, I think, if you looked at most of that sort of glamour growth investing style, you're going to see a portfolio that's, yes, it's expensive. It's expensive because of that much higher growth that has been observed, and that in each case of these, if you're holding the company, you expect that growth to be delivered going forward as well. And again, so if you're looking at this, you'd sort of think, well, this is WCM looks like another or any other sort of growth manager. Now, one of the areas why I find them fascinating is the business of themselves is a really fascinating story. And this is the PM team here from WCM, and I've been lucky enough to visit probably over 100 managers around the world as part of the research trips I've done, and in this role and previous roles where we go and visit investment teams, go and meet with the people sort of on the ground. We look at the managers that we work with. We also look at some of their peers, what we could sort of think about as our reserve bench. And I think of all the visits I've made, the WCM team is, I think, one of the most interesting stories. So the website there is referenced. If you do have 5 minutes and you want to see a cool story, I think it's a great read. The PM team there, a co-PM team. So like I said before, typical for us to like a sort of collective approach, not one individual, but Paul Black there in the middle is he's not one of the founders of WCM, but maybe over 20 years ago, Paul and a few other younger folk bought out the the founder, if you like, of WCM. And if you're interested in the story, that webcast there I've shown does a good job talking you through it. But just to give you the highlights, the founder of WCM sounded like a bit of a tyrant. Maybe it was typical of an asset management firm in the 80s and 90s. It was his show, and his way or the highway. So when Paul and his younger, or at the time young colleagues bought out the owner and had a chance to run the firm in their own way, they basically decided to do it the exact opposite. So they've built this firm on the basis of having a really strong internal culture. Now, a lot of companies around the world in financial services and outside of financial services spend a lot of time on their internal culture. It is, no kidding, very important. And I just think these guys take it to the sort of nth level. They've got everyone's got a chief people officer, they've got a chief culture officer. But where they've taken it one step further, as well as their own internal culture, is that the culture of the company they're investing in is super important to them. So the WCM approach, when they're looking at these exciting companies doing with a cool product, a cool service, a cool technology, their sort of philosophy, core values, and key tenets at the top there, the culture is super important to them. And is it easy to assess the culture of NVIDIA or a Saab or a BAE? No, it's not. But they've got, as well as investment analysts, sort of what we might consider classical financial services analysts, looking at these companies' balance sheet, earnings power, industry concentration. They've got a handful of cultural business analysts who are trying to assess these companies for the health of their culture. They think, that these, as a growth manager, they're looking at what does this company have, what sort of moat, think about Porter's 5 forces, what sort of protection does this company have around its business, around its future revenue, but more importantly than the moat, what's going to make that moat bigger? What's going to sort of improve that moat? And for them, the culture of the company is a really important thing. And then even as we look at the core values of the business, they've written white papers. I find them a fascinating read. They look at the funds management industry and sort of say this industry is crazy. If you make a mistake, a lot of people sort of try and hide it or talk about their winners. They are so open about previous things that didn't work out. They look to sort of assess them and learn from them. And even, when they underperformed in 2022, that was not the first time they'd underperformed. They've been together a long time. They've had other periods where they've had some tough times performance-wise, but just the way they go about handling that, the way they learn from it or look to learn from it collectively, I think it does stand them out as been totally different. And maybe I should have started with the one other difference. As you can see from the photos, these guys aren't based in sort of New York or Chicago or Boston or London. One of the things they had the choice of when they bought the business was where did they want to be based. So they are based in Laguna Beach, sort of a little community about an hour south of LAX in Los Angeles there. And even there, sort of when you visit them on site, their workplace culture, they basically, there's about nearly just under 100 of them. They are sort of, their building is an old pottery shack from the 50s when Laguna Beach was a sort of hippie colony for artists and pottery folks. So they're quite unique. I really always great to talk to about how they're finding names, what they're looking at. They've recently just not for our fund, but they've recently just launched a portfolio, a small, a concentrated fund that will invest in companies that are about to be listed. So that whole, they're effectively moving into sort of that early stage investing of companies that have been around in the unlisted sort of part of the world, and they're going to be moving to the listed space. Now, why are they doing that? Because a lot of these companies are based on the west coast of the States there. A lot of them come to WCM and ask for sort of any tips or advice or guidance on how, what is the reality of being a listed company? We've been, privately owned. Should we go listing? So they sort of felt that they know the ecosystem so well. They're looking at some of those unlisted companies as competitors to their listed portfolio holdings. So that was a natural progression, a natural evolution for their business. And again, I just think it makes the way they're looking at in our portfolio, it's purely listed names, but even their sort of knowledge and ability to look across that unlisted universe is a really important sort of thing for a growth investor in particular to focus on. I'm going to stop there, otherwise I'll talk all day and help you from your lunch. But I just thought I just wanted to bring the high growth to life a bit, and like I think some of you are familiar with some of the managers within the multi-manager approach, and I just wanted to spend a bit of time talking about, like I said, one of the more fascinating managers I've ever come across. But I'll pause there, and if there are no questions, we'll let you get back to your lunch.
Fantastic. Thank you, Alan. That's a great overview of the Nikko High Growth Fund, which launched on GoalsGetter on the 1st of July. So for those of you who haven't seen it there yet, go and take a look. Now, a reminder, if you've got any questions you want to get answered in the last few minutes of this call, please put them in the Q&A feature now. We've got our next lunch with GoalsGetter coming up. The date and the speakers is yet to be confirmed, so keep an eye out for the invite in your emails over the coming weeks for that. And still can't see any questions coming through, so I think we'll wrap the call up there. Thank you very much, Alan. That was a great presentation, and I'll let you all get back to the rest of your week, and look forward to seeing you over the coming months under the new Amova brand. And just reach out if you've got any questions around any of that. See you later.